Welcome everybody to the fourth episode of OpenYield Markets with Mark. We are extremely excited today to have Matt Smith, Smitty, who's the founder and CEO of a fintech firm, Spline, a next generation infrastructure of quantitative municipal pricing. Spline offers three core products in secondary market pricing, real-time yield curves, and predictive analytics for new issue pricing. Matt founded Spline in 2022 after being the head of trading at Headlands Tech Global Markets. He is a graduate of North Carolina State. Go Wolfpack!
Marvelous
Actually,
sound.
yeah. One thing I should tell you, actually, a very close friend of mine from Syracuse is the voice of NC State now for football and basketball. So,
Very
um,
cool.
yeah, if you're ever down in that area again. So, um, if you're serious about how machine learning is redefining fixed income, this is going to be the podcast for you. I'm very excited to have him on the show. And as I coin every guest, today we have the Reverend Thomas Bays of fixed income trading on the show. And if you don't know who that is, I implore you to Google or look it up. Many of you guys out there will know, but Thomas Bays is one of the, if not the founding father of predictive analysis and statistics. So we are more than excited to have Matt Smith on the show today.
Well, thank you very much. And I think that reference is maybe reaching a little bit. I'm not responsible for any discoveries in the math world, just building on the shoulders of giants. But thanks for having me and listened to them all so far. And I think the Muni market definitely needs some more content in this space, right? It's hard to have these kind of conversations.
I always aim high. So I usually, everybody I've had on the show so far says that the terms I use is a little bit of a reach, but I always aim high. It's one of those shoot for the moon things and maybe you'll land in the stars. So,
I
you know,
gotta
I
respect that.
yeah, I guess we'll start out. I mean, a lot of people probably out there know who you are. I mean, I actually did a little pre-marketing, letting people know that you're going to be on the cast and you have a nice following. But for those of the people who don't know what Spline is or don't know what you do, if you wouldn't mind just giving us the basics of who you guys are and what you guys are doing, that'd be fantastic.
Yeah, so Spline data. Spline was taken, unfortunately, by some like 3D design software. Um, but I started Spline very shortly after I left TD, and the problems that we were trying to solve were pretty straightforward, right? Like I had experience kind of dealing with some of the curves and some of the evals in the muni market, and I saw a few opportunities there, especially to kind of take uh, a more algo-oriented approach to some of this, and all the buzzwords were there, right? Like it's a fragmented market, it's illiquid, there's sparse data, and all of those buzzwords really appeal to me, from a problem-solving standpoint. So we immediately kind of set out to solve yield curves and then pricing, and then primary has been kind of a newest addition for us, but it's all done with the goal of making automation a lot more attainable for the broader market, and then for those who kind of already have it, to just give them another opinion, right? An example that I kind of go to a lot is, you know, if you have a great pricing model, it still probably has noise. Our pricing model has noise as well, but if we're lucky and the thesis works out, that noise will differ between the two and kind of cancel each other out, and the combination of two will kind of be a better product.
So you'd say that, when you were at Headlands, you basically said, hey, here's a problem, an addressable problem, and it's not exactly core to what I'm doing currently. Maybe I can spin myself off and address this problem in the marketplace. For the layperson who's not in munis in general, could you, in layman's terms, just explain what a yield curve is and how your pricing model attacks it?
So yield curves are a very interesting corner, or keystone of the muni market. Let's say it's not as simple as um, a treasury curve, where you have quotes on both sides and you have benchmark securities. Munis are very different in that there's no true benchmark securities. There's index eligible securities, but they might not trade every day. They might not even trade every month. And so you're taking a lot of disparate, kind of unrelated information and trying to cobble it together in a fashion that looks like, uh, a treasury yield curve. There's also some structural differences, right? You can't short muni bonds, so you don't see, posted offers unless somebody owns the bonds. A lot of times bonds just get bought and put away and never offered again. So it's just kind of a fact that we have to deal with in the muni market. Um, so the problem solving is a lot different. Uh, the way that we've kind of gone about it, um, for the yield curve is that, eh, and as a side note, believe it or not, the yield curves have been the most challenging part or the most challenging thing that we've built. Um, we're constantly trying to weed out bad data, but also emphasize good data. We're trying to make sure we have enough data, which is frequently a problem. Like we don't ever have AAA 30-year bonds to look at, and so coming up with the 30-year tenor of the curve is very hard and requires a lot of extrapolation. And then we also have to simultaneously try to make the model flexible,
Yep.
so that it's reacting very frequently, but it also needs to be very robust and stable, right? We can't have, 5 bip fluctuations between 10, 15-minute intervals. And so it's kind of a giant balancing act that uses very little technology off the shelf. It's one of the few pieces of code that I've written that doesn't use libraries, modeling libraries or anything like that.
That's very interesting. So I guess that's actually a perfect segue into your product suite, right? You have three main products. And I don't know if you want to go through each of them: secondary pricing, real-time curves, and then, what I think is the most fascinating to me as somebody who's still learning munis is how you have a predictive model for new issues. But if you wouldn't mind just going into each of your three, core products a little bit more, that'd be great.
Okay. Um, yeah, I guess I'll kind of go in order of how we built them. It was like a very logical progression, I guess. Um, and just as a general note, pretty much everything we have updates every 5 minutes. It runs from 8 a.m. to 5 p.m. And then it varies by trade size. So we have odd lots, round lots, everything in between. Uh, that's a common denominator. I just don't want to be,
So
repeating
you can
myself.
actually you're saying that your spline data updates every 5 minutes from the oddest of odd lots, to for the whole curve. That's pretty incredible compared to what the marketplace has before you, which is what, three general updates a day from a MMD or other.
Yeah, and it was a little bit overkill by nature. It takes a lot of optimization to make these models run quick enough to
Yeah.
update every 5 minutes.
Yep.
But we did so we don't have to think about it for at least another 5, 10 years, maybe 5 years. We might be up to 1 minute by then. Who knows? Uh, but most of that was just optimization at that point. And I have not myself to thank, but my CTO Thaddeus, who he's done a lot of low latency um, HFT type work, and so he ultimately took a lot of our code and then just made it very fast. Um, but it's a constant struggle trying to squeeze new bits of data in and do so in a prompt manner.
So let's go into just the yield curves one more time. So take today's muni market and take, how Spline data has made, what I would call yield curves more efficient, or has given confidence to your clients and your users to use your data when it comes to, either, from the sell side making markets or from the buy side having confidence in what they're buying or selling.
Yeah, it's one of those like foundational pieces of information. It's like, okay, what's the market doing, right? The analogy that I use is always like it's kind of like the Nasdaq index, right? If you're looking at Apple, you're probably going to know what the index it belongs to is doing. And so it can serve a lot of purposes, right? You can build a pricing model off of it, or you can manage your flows to it, or you can spread things to it to find opportunities in RelVal. And however people use it, I mean, it varies to a very substantial degree. But the curves are very central to what we're doing, right? So we've really had to nail it. We're continuously like putting a lot of effort into trying new things. I'd say 95% of them don't work out. But despite how difficult it was to build, I think the product itself is pretty straightforward. They're just ratings-based curves that update every 5 minutes. Um, uh, One of the biggest differences, though, I think what you'll see with our curves is that they're purely data-driven. So, and what I mean by that is you know, we could probably do with some contributor information. I'm sure that's very valuable. But at least from our standpoint, like we saw a lot of information that was being missed by some of the traditional data providers in the odd lot space.
Yeah.
And that may not have been super relevant 10 years ago. It's hard for me to say. Um, but, knowing what the market looks like now, odd lots have become actually a pretty good indication of balance sheet in the space, right? If there's no bid on the odd lots, then you can kind of infer that people are tapped out. And so, when we were coming up with these curves, we were trying to figure out how can we use that information? How can we use that inferred balance sheet information to figure out where the market is heading? And it's framed, you know, to predict the next 5 minutes, not reflect the last five. And that's kind of an important distinction. It's like given all the information we have up until now, statistically, like what's the most likely next outcome?
That's actually a pretty fascinating point is that, using inference on even the odd lots, which many people wouldn't have thought of, but okay, what can we deduce if people aren't pricing odd lots? Okay, we can deduce X, Y, and Z. And in that case, and we can then predict something that could be reflective of that in the next intervals or whatever. That's actually pretty fascinating. Something honestly, I've been trading sell side for 20 years. I didn't even think about it that way. And it makes sense when I was, or any trader was getting close to their limits, if you will, or whatever it was, or your risk tolerances. Yeah, you would stop pricing the smaller stuff and just focus on reducing whatever you did have. Yeah, I mean, it's actually pretty interesting.
Or
Um,
bid them really wide too, right? Like the bid
yeah,
ask
or you
tells
bid,
you.
or your bid ask exactly. So I guess segueing into the next kind of area of what I wanted to talk about today is, who's taken to your platform the most? Has it been sell side, buy side? Has it been a mix? Is it different? Is it different strokes for different folks? Or as you've been marketing this, who's really taken to it so far?
Uh, it's definitely been, predominantly sell side, but we've recently seen, kinda growing interest from the buy side. The sell side adopting this quicker, it just makes the most sense, right? Like, our
Yeah.
value proposition is very straightforward. For them, it's, "Hey, we can give you better, more accurate market information," and then they can directly turn that into, dollars. So
Yep.
it's not too hard, to convince them from that standpoint. What has been kind of a challenge, it's the challenge that I signed up for, right? Like munis are not the most technologically advanced market in the world, and so I always say that half of our product is the data, the other half is helping people make use of it, right? You can give somebody a crystal ball. That doesn't mean they're going to make $1 million. You kind of have to show them how to use it, say the magic words, abracadabra, and then boom, good trades, right?
You have to have a good shake too. A good shake is actually very important on a crystal ball.
Makes me think of a magic 8 ball.
How did your data handle the volatility we've had in the last couple months? This is the first real wave of volatility the market's had really since 2022. How did you guys, how did it handle it?
So fortunately, I traded through COVID. So it was certainly at the front of mind that the model had to be able to adapt to this kind of regime, and just regime changes in general. I think it's so easy in the muni market to kind of get locked into, okay, ratios are at 65%, they're going to be here forever. Um, but clearly that's not the case. And so
And real quick, could you explain again, because my audience is expanding, hopefully. Could you just explain in layman's terms what ratios mean just for the layperson?
yeah, it's just a relative value metric that folks use in the muni market. So like relative to treasuries, what's the yield of munis? And
Perfect.
typically it's lower than treasuries
Yep.
just given the tax exemption, but people
Perfect.
use all kinds of things.
Perfect. So continue. Sorry, I didn't mean to interrupt about the volatility though versus COVID versus now.
No, no problem at all. So we built the model in a way that can identify short-term trends and data and kind of change the way that it thinks about the market. And so initially, our error was much higher. I don't think you could ask anybody, in the entire, muni data space, and they would tell you their error got lower. That's just not
Yeah,
possible, right? You
not,
can't.
not feasible.
But uh, what was really important is that the midpoint really held up. The where the model was kind of based around, really kept track with what yields we're doing. And so, while we may have been too tight initially on bid, or too tight initially on offer. We eventually kind of matched that, and then they came back in, and the reverse happened. But the whole time, the midpoint of our model, which is effectively our curves and our pricing model, really kept up. I think we saw, a few instances where the day the opinion or the direction of the day looked like it was going to be 30, 40 bips cheaper, right?
Right.
And at some point we would get to that level, but then something changed, right? Maybe the RFQs that were being executed for the day wasn't as brutal as everybody kind of foresaw, and so they're, hey, I need to put on some inventory, bonds look super cheap here, market rallies a little bit. And so we saw a couple times our curves go from 30, 40 bips cheaper to in the day, 20 bips cheaper.
I mean, I know it was a pretty crazy time for 2 weeks there. Now, we're starting to settle out, and it seems like from everybody I speak to in the muni world that, things are all hunky dory again. Everybody's going one way again. So I guess the speed of your model and your data is really what drives confidence in the people that are using your platform.
Yeah, and you know, these people are seeing the same thing too, right? So part of it is just validation, especially in these super, bottom falls out of the market environments. Like, you have a pretty clear idea of what's happening, but there's all this information that's saying otherwise, these little bits and pieces of information saying otherwise, and it's hard to ignore that, right? And so you might, if you're only relying on your observations, you might say, "Oh, I'm going to bid really wide and offer really aggressively because I don't want to be caught on the wrong side of the market." But if you have another perspective that totally validates what you're thinking, or is at least in line with what you're thinking, then you're going to be a lot more confident trading into those events. And that's how you survive that stuff. It's like you can't fight, the paper losses, but what you can do is make up for that in buying and selling bonds.
So it's what's really another stat about Spline data is so far you've been going since 2022. You've had near zero churn. And I know, we are a startup. We're also happy to announce that we have zero churn so far. However, we've only been going for, a matter of months in our quest. But when you talk to other, folks in the startup world, churn is a real problem. It seems like your customer base is loyal. The product must be pretty unique, and also must be something that where they have confidence in. What's the main feedback you've gotten from customers that you've had on since inception, and some customers that you've most recently onboarded? Because so far your loyalty is or customer loyalty is near 100%, which is pretty incredible.
Yeah, and I don't want to get too comfortable with those ratios.
No, of course
Uh,
not. But for now, you know,
for now, I can be happy with that. And I think a lot of it just boils down to our relationship with our customers. And again, that goes back to, helping them make the most of the data. Oftentimes, we'll get on hour, 2 hour long calls with our customers and just help them brainstorm on, like, we have this problem. It may or may not be related to our data. And then we'll help them come up with a solution, kind of totally agnostic of whether they're, big customers or little customers or in betweens. um, we want to see people succeed, and for me, that's the stickiest product that I could sell. If they can build a successful business on top of our data, they're not going to be motivated to build out of it. Anybody can sit down and build a pricing model, right? I'm not.
not anyone. I can tell you right now, I couldn't do it. Almost anyone could sit down and build a pricing model.
I think you could give you a couple Python classes, and we
Yeah.
get there. Um, but what we're doing is not impossible. And so we have to build our moat in, helping people succeed, because the whole picture is important to selling the data, not just the data itself.
Okay, so you're going to try to help people succeed. What's next for Spline Data outside of munis? Once you've gotten to a place where munis is humming, what are the verticals are you looking at? Where do you think that where you guys could disrupt things would be very useful?
I'll first say I don't think we're ever going to quit munis, or like, I know that's what you're saying, but
Yeah.
not what you were saying. But we're never going to, like, direct focus away from munis, because uh, I've mentioned it a couple times, but error in this market, it's the number that guides the arms race between all of these data vendors, right? And
Yep.
unfortunately, it makes me think of the I think it's a Mark Twain quote. There's lies, damn lies, and statistics. It has to be one of the most abused metrics in this space. and not just munis and not even just data vendors. Traders lie to themselves all the time. I used to do it myself. And so there's a lot of ways to manipulate the overall metrics, and it makes kind of any of them hard to trust. So, from my perspective, the best we can do from that standpoint is just to be as honest as mathematically possible. And on paper, that might make us look to be worse or at a disadvantage, but the trust and the ability to like help our customers derive value from the product is far more important to us than getting that first phone call. So we will be focused on bringing that error down. We will be focused on bringing that skew down. But we're always going to have this connection kind of with our customers on an ongoing basis. And we spend a great amount of time on the pricing model, on the yield curve model, on the primary model, even though it's done, so to speak. There are people using it successfully, but we could always make it better. Aside from munis, I'm very interested in illiquid products in general.
Yep.
I don't think corporates are a next stop for us. I think we're probably going to go the other way. I'm particularly interested in spec pools, always have been, always will be. Don't understand nearly enough about them, but passion is what got me here, and passion will push us forward. So I'm just going to focus on the things that I'm interested in.
I like that. I like that. It's good to have passion. Passionate people usually succeed. I was going to ask you about what 5 years from now looks like in munis, or the future of munis. What I'm seeing in my seat, in my perch, is the proliferation of electronification, automated trading in munis, which I feel is really starting to pick up. I think corporates, kind of led the way, if you will, in credit, and now munis is just really playing a game of catch up with everybody that I've talked to, either doing it actively now, or spending mass budget to do so, or really putting a roadmap forward for munis. What do you think the biggest change will be in the next 5 years in the muni trading landscape?
That's a good question, and one that I ponder fairly often. There's definitely the parallel with the corporate market, right? Where things are becoming more automated. You're seeing protocols like portfolio trading come out. You guys are trying to get resting bids on munis, which I think is awesome. And we would
Correct.
love
That's
the
coming up
data that's
soon.
available. And so I think you'll see the market continue to modernize in that aspect, and clearly automation is going to become more and more top of mind for a lot of folks. I I I think the structure of the muni market, though, primarily not being able to short and not having a great hedge, uh, is going to keep it kind of interesting, right? Like there's so many more CUSIPs than the corporate market. You can't short any of them. You can't easily hedge any of them. Um, and so I don't ever think munis are gonna get to a point where they're as tight as corporates, right? I think that there's always gonna be some demand for balance sheet to say, "Here,
Yeah.
hold these bonds when I buy them next week," and, um, people are gonna have very varying degrees of risk tolerance for doing that no matter how automated they are.
Okay, a couple quick hits. That's the main content for the show, but a couple quick hits for you. One, has anybody ever told you you have the best mustache in munis?
I don't I don't wanna claim that title personally, but, I'll accept it. Sometimes I shave it.
Of anybody I've met so far, you are number one. You are. I would actually, maybe I should coin you the mustache of munis. I
I
like.
understand that one a lot more. I like that.
uh, Number two, why did the Muni CDX index fail? Like, why did it never take off? MCDX. MCDX, and by the way, this is something when I was trading sell side, MCDX came out probably in the 2010s as a means to be able to trade munis both ways or to hedge it, and I don't know the underlyings, right? The CDX index has 125 underlying credits. I couldn't tell you the underlying in the MCDX, but I know that it only lasted actively for a couple of years, if that. And I
Did you
just didn't know
trade
if
it?
you, I didn't, I was sitting on the other side, and I was like, oh, this is actually pretty fascinating. And then a year and a half, 2 years later, it was just not feasible. And I'm going to guess it's because of the liquidity of the underlyings or what the underlyings were, but I just didn't know.
Well, I guess was it a tradable index?
It was a tradable index, yes,
Okay.
both
I
ways.
then my answer is my answer for why didn't something work is, 1, it wasn't tradable, or 2, there's only interest in one side of the
Yeah,
trade. And I think you know,
that's
munis in
probably more of
general.
what it was. Yeah.
Yeah, it's like there's no borrow on MUB. right?
Yeah.
It's kind of the same situation, but there's a
There
little
you
bit more retail demand.
Actually makes total sense. And then finally, can you tell me the origin, the definition of the word spline, where it came from
Um,
originally, before the mathematical uh, version of spline?
oh, I have no idea. I thought you meant how I came up with it. I have a boring answer and a
Oh,
fluffy marketing answer.
yeah. Well, give me the boring one and the fluffy, and then I'll give you. I looked this up. It's not like I knew this on my own, but I have to do my homework for all these podcasts. So in doing so, a spline, which by the way fits what you're saying, was originally a wooden or metal tool used by shipbuilders
Mm,
to create a curve.
feel like I knew that actually.
You probably
Uh,
did, yeah.
Somebody has brought it up to me before at some point. We get people call us spleen, spine.
Yeah.
We get all kinds of stuff. The boring answer is like it was just a kind of punchy name, and it was math based, right? We wanted to kind of point to the modeling aspect of our business. We don't actually use splines directly
Right.
to come up with our curves, which is kind of funny. I started with that, but there were some limitations that hampered our accuracy. Um, and my marketing answer is that clearly we're the smoothing function of this fragmented market, and we help connect people to points on the curve.
See? And that's what we were going for. And by the way, folks, we didn't actually pre-do this. That was all off the cuff. So I didn't actually set him up that softball, so nicely. Uh, Listen, I really appreciate your time today. It was a great conversation. Also, a really good learning experiment for me as I still delve into the greater part of the credit world, immunities and whatnot. But this was a great conversation, and we really appreciate Matt Smith, Smitty, for being here. The Thomas Bays of fixed income, also the mustache of munis. So thanks for all your time today, and we'll be in touch. Thanks a lot. This is Open Yield Markets with Mark podcast.
Thanks so much.
All right, thank you.